Hey, and welcome back to Kyle's Finance News. I've been gone for a good 9 months working on some other projects, some other YouTube channel ideas. Markets continue to keep moving though, and I know there is a lot of speculation and fear going on in markets currently, as well as there has been since this new administration took place, and we've got a lot of fear around tariffs and the evolving headwinds on markets due to concerns from other countries and conflicts in other countries and other parts of the world. I just wanted to get back on here and post a quick update. Market performance, the S&P 500 was down at one point this year over 20%, 21% to be exact, in Q1. And there's not a magic formula here, right? I'm not trying to sell anybody on anything. I'm not trying to say my way is the only way. I'm just posting what works for me. So for the record, the S&P 500 is only up for year to date, so since January 1st, 7.83%. And I am currently up 46.27%. Now, that's not me trying to brag or boast about my positions or my performance, but it's to highlight the effectiveness of just averaging down over time and continuing to add and build your core basis, your core positions as time goes on, regardless of whatever market conditions or whatever fears or concerns or headwinds are present. So take Q1, for example. When the market started sliding 5, 10, 15%, I just continued adding on the way down. Now, I've explained in videos in the past that ideally you have some cash on the side in your accounts. That could be 5% of your total account, 10% of your total account. It's up to you. Have your core emergency savings set aside first, and then in your investment accounts, start building up a little bit of excess cash so that you can take opportunities such as this and capitalize on them. Because if you're not able to buy when the market is down, then you're just facing months of stagnation, of just nothing happening in your account. You might be making some from dividends, but overall the performance is not going to, it's not going to be working for you. So when the market was down 10%, I took a little bit of my cash on the side and I bought in. When the market hit negative 15%, I took a little bit more cash and I bought a little bit more in. I'm not draining my entire cash fund until it hit negative 21 some odd percent. There was a particular weekend there in March where the markets had hit, I want to say negative 22% or so was the lowest. And I remember telling my partner, I told her, I can't not buy. It's too good. The prices were just too good. Everything was coming way down low, way fast. There was a lot of panic. There was a lot of fear in the markets. I couldn't not buy. It just did not make sense to not go in hard. So I took all my remaining available cash and I bought the next day, the very next morning. I didn't care what the price was. I didn't care where I thought it was going to go. Negative 20% on the indexes. I said I'm going in. Now, could it have gone further down? Absolutely, it could have. And I could have been saying, man, I wish I had a little bit of extra cash still left over to buy even lower. That's just the nature of the beast. But negative 20% off, that's a heck of a discount. So I was more than happy to jump on that. And it worked out really well for me so far this year. No complaints there. But will that always be the case? Not necessarily. What can we look forward to throughout the rest of this year? Really, it comes down to the Fed. Always the Fed. It's always about Jerome Powell and his fiscal and monetary policies. Markets are by and large, from my perspective, pricing in future rate cuts. And what we're seeing as time evolves is that cuts are getting delayed. Cuts are remaining skeptical from the perspective of the Fed. And as we go on to have those rates not come in, or have those rate cuts not come in, not take place, I think the market will start to get a little bit more weary and upset about that. And the reason for that is because when the cuts come, will the cuts be bearish or bullish, right? What is the underlying decision-making process for those cuts when they do eventually come? Because the argument for them now is that inflation isn't going to keep going up. The market's doing great. The Trump administration wants rates to come back down to incentivize borrowing, to incentivize the taking out of loans and the borrowing of money. And that will in turn further promote the growth of the economy. But when the time comes for cuts to actually take place, will it be because the Fed waited too long and now they're having to act in a manner of trying to bail out some of the economy by making it easier to borrow? Or are they really confident that inflation is now managed and not going to be a problem going forward? Now, they keep saying inflation is up in the air because of tariffs. I'm certainly no Fed expert, right? I don't have a degree in economics, or I'm not saying like I know more than Jerome Powell does, but I'm not really seeing where the tariffs are going to have a significant play in this role so far. The tariffs largely seem kind of for show. There's a lot of deals that are taking place that aren't really massively benefiting America in the way that they were originally kind of proposed to be benefiting America. And we're putting tariffs on countries that really don't export to the US at all in the first place. Now, that's not the case universally. You have Europe and Canada and Mexico and China, for example. Obviously, we do import from those countries, and so large tariffs on those countries are going to have a massive impact. But when you tariff Canada and then you put in a bunch of exemptions for farming and agriculture and produce, and then you tariff Mexico and you put in a bunch of exemptions for auto parts and manufacturing and inexpensive labor, then what is it exactly that we're trying to explicitly target? We're not using them to their full extent. There's a lot of exceptions in these tariffs that kind of negate their point. So on paper, yes, we are tariffing countries pretty intensely at the moment, but in the details, there's a lot of exemptions that kind of negate their full face value. And the original idea of these tariffs having a massive impact on inflation in a negative way and really spiking inflation, we're not seeing that take place. We're getting these new inflation numbers month over month. And while, yes, there is a small spike in the recent 2 reports or so, it's still relatively very low numbers. We're still in the 2%. So we're not seeing the 3, 4, 5% that was theorized when this administration came in, and that this was going to be a big problem. I don't know why the Fed is still being so hesitant to cut rates here, but I imagine that will start changing here very shortly. I would be surprised if we don't have at least one, probably 2 cuts in between now and the end of the year. So there's 5 more meetings or so, I believe, maybe 4 or 5 more meetings. And almost certainly we're going to be down another 0.5 to 0.75% before the end of the year. I can't help but think, though, what if there is a small chance that inflation does become a problem again and inflation does spike? what would the economy look like if we didn't cut, but instead we ended up having to raise rates? I think that would be unprecedented. I think that would really have a negative impact on the market and the performance of indexes and the effect on the American people. I hope that does not take place. I just have to consider both sides of the potential outcome here. How would I position myself to be bullish for expectations that rates will eventually be cut and they will be in the conditions that inflation is under control? But how do I still somewhat kind of prepare for a doomsday scenario where inflation does start to tick up higher and higher, faster and faster, and now we're raising rates to continue to keep inflation under control? The cost of borrowing goes up, credit card interest rates go up, auto loans go up, mortgages go up. That would certainly not be good. I am keeping that in mind. In the meantime, cannot let the media put you into a panic. That is all they're going to do. That is how they make their money. As long as they're getting views, as long as they're getting clicks, they will say whatever they have to say. They will say whatever they have to say to get you to click, to get you to watch. I'm not going to be distracted by the fear mongering that takes place. I am just going to do what my rules say that I need to do, and that is buy at certain levels and rotate in and out of positions when they become too large or too small. I try to position appropriately, and my day-to-day activity is not checking in on the news or checking in on what tensions are happening in other countries or in other parts of the world. I'm concerned about managing the risk in my portfolio and focusing on my life and my work and my hobbies. That's what it's about. It's not about social media and what mainstream media is doing. So I hope that short little bit of information might provide some guidance to somebody out there who is feeling some fear about markets and not sure what to do. I've had comments in my videos in the past of people saying markets are going to turn over. You don't know what you're talking about. All-time highs aren't going to come, and that's okay. I understand why people have those fears, but lo and behold, new all-time highs were made shortly after those comments were made. And yes, we did have a bad Q1 months after those comments were made, but we buy the dip as we always do, and we are already back up in all-time highs, not even 3 months after that. So it's amazing how far you can move in 90 days. The market was down over 20%, and since then it has rallied back over almost 30% from there. So you're talking a nearly 50% down and then back up total move on the S&P 500 in less than 6 months. That is significant. This is like COVID 2020 all over again. So thank you for watching. I hope you found this useful, and I will post another video eventually.